page from the company page instead. So we're just working out the bugs with that. But if you have never tuned in before, my name is Jerry. I'm the owner, founder, CEO of Wealth DynamX. And I do these courses every single week. Okay. Every Friday we do these. We've been doing these for several years now. And tonight's topic is the topic of investing. Okay. Investing. Now, we're going to talk about investing a little bit differently than we have before. I'm actually going to highlight the differences between investing and speculating because it's something that I see happening quite often. I had a buddy of mine text me today. He's like, hey, you really need to hit this because of, all of the meme stocks and crypto and tech stocks and, companies that have little to no earnings and people are out there buying them and putting money into them. I don't think people understand the difference between investing and speculating. I agree with that. So during this course tonight, my intention and my aim is to give you guys a good, clean, clear difference in definition between the two so that when you're intending to do one of them, you're doing that thing, right? It's not a scenario like what I see happening now, where I think a lot of people who believe they're investing are actually speculating. The outcome is going to be entirely different, right? Speculation is not an investment. Now, a little bit about my backstory is some of the stuff I cover every week. I was a financial advisor for a number of years. Okay. And I did that successfully with Dave Ramsey. I worked with several large agencies. I had my own firm. And eventually, I started to see that I call it the retail or the mainstream financial world isn't what the wealthy use. Right. And as I started researching that, I started seeing more and more of the back end of, Wall Streets and banks and all of these institutions and organizations that we often give our money to. And I realized that on the front end, it's usually and often dressed up as investing for the consumer, for the retail investor, for the person getting involved, right? We will look at that and we'd say, hey, I'm investing in this thing, or I'm investing in such and such an object, right? And the reality is it couldn't be much further from the truth. On the back end, often there's lots of speculating involved, right? We don't know that because we don't know what speculating often is. Banking, for example. Right? If you're putting money into a bank account, did you know when you deposit money in a bank, we put it there because it's safe, right? But they're allowed to use the bank funds and deposits essentially like a hedge fund and speculate with them. Okay, we think that we're making an investment where we're going to earn interest, the money is going to be safe, it's going to be there. But on the back end, again, these institutions have disguised it into this wrapped up, definition of investing, and really it's entirely different. So what I want to go over today and what we're going to cover is what are the differences from a retail standpoint, from an investment standpoint, from an individual standpoint. If I have money and I'm looking at putting that money to work, how do I know when something is an investment? How do I know when something is a speculation? Right. So that's our topic. Now, before we dive into this, some stuff I cover every week. First things first is if you are watching this and you have questions, ask those. Right? Make sure that you are focused on, if you don't understand words I'm saying, if I'm going over mathematical concepts that don't make sense, you ask. Because what happens with finances is we get stuck on these misunderstood concepts, words, math equations, whatever it might be. And then we give up on the topic and we say, oh, I'm not smart enough. Let me give up on money. Now I'm going to make money and everything's, revolving around money, wrong and incorrect. Right? Which is something that really kills us. It locks us into being that, retail consumerism or poverty or middle class or whatever it might be, because we never think we can learn this stuff. Right. So that's the first thing. Second thing is, I want you to have a purpose for being here. If you're watching this tonight, why are you watching this? Are you trying to gain financial education? Right. And if you are, okay, then I want you to think about, okay, well, how am I going to apply the information that I'm learning? How am I going to apply the information that I'm learning in my life with investing and with finances? Right off the bat, we have a really good question already from Daniel. Let me answer this really quick. So Daniel asks, why do you put so much emphasis on the word retail? What does that mean? So that's a great question. When we talk about finances, retail means it's for consumers, right? It's a product, right? So retail, if you think about when you go shopping, you go to a retail mall or outlet, usually you're paying the highest prices. Usually you're involving several middlemen. You've got the reseller, the retail storefront, they buy it from usually a distributor who usually buys it from a wholesaler or a broker who might buy it from another wholesaler or a broker who buys it from a manufacturer or a producer. And so usually there's 3 or 4 people that have made money by the time the end user gets their hands on it. With investing, it's not something that should be retail because you're packaging up just math formulas and ideas. right? So when we get retail, it means we're buying the most expensive investments, and we're buying the stuff after 3 or 4 parties have already gotten all the profit that they want to out of it. So it's the most expensive, least profitable, and typically the most risky, right? So that's what I mean by retail. That's an excellent question by Daniel there. So just like that, guys, ask your questions. These are things that I'd rather have you be dumb for 5 seconds than for eternity, because we never ask these kind of questions, right? So, and then finally, make sure that you've got a mindset of production. How am I going to use the information? How am I going to produce with it? It's easy to consume it. It's easy to learn finances. It's a whole different ball game to say, okay, I'm going to go win with the data and the info that I'm learning tonight, right? So that's what I want to cover. Obviously, be positive, be respectful. We don't want critical. We don't want, people that are negative, that are here just to, be the back row seats in the theater that are throwing popcorn and hawking loogies on people's back of their heads. We're not interested in that. We want to be here with people that are productive, learning, that are spending their Friday night, figuring out finances and improving. Now, this investing versus speculating, this is really what I'm going over tonight. This is the main focus of the topic. I want to give you a couple of definitions. Okay. And my screen is a little bit hard to see. Let me see if I can make that a little bit easier. I don't think so. So let me just read some definitions to you guys. So investing means that I'm going to acquire something that offers potentially profitable returns as interest, income, or appreciation in value, right? So that's the definition of investing: acquiring something that is potentially profitable. Now, we use this word potentially because nothing is guaranteed. Everything with investing is potential. We're potentially profitable. We can't say we're going to be, because there's no guaranteed investment out there, but potentially profitable with returns. Those returns are going to be interest, income, or appreciation in value, which means I'm either going to earn interest, like I'm earning a yield, or I'm loaning money out or depositing money. I'm earning interest on that, like you might get with a loan or with a bank, right? Or I'm getting income. I might get income in the form of rent from real estate or a dividend from a stock portfolio, right? Or appreciation in value. Now, specifically, this word value is there. Definitions, guys, we can't just gloss these over. Every word in the definition is there for a reason. And it's important not to confuse them with other words. Appreciation means something is going up, right? It's increasing, it's growing, it's expanding. This is value, okay? It doesn't say price. I want you to think about that. The difference between value and price. This is saying we buy things that appreciate in value. That's not always reflected in price. A good deal is when the value is higher than the price. When the price is low, the value is high. That's when I want to buy, right? So if I'm watching something on price and I'm looking at the price is going up, I need to get in. That's usually actually not a good sign. Okay, because the price, again, like Daniel asked, retail, that's what the end user pays, right? For example, the price of gold. You might look at the gold price on the market. There's a retail price of gold. Okay. Prior to that retail price, there's going to be a broker that pays a cheaper price than the retail. There's going to be a wholesaler that pays a cheaper price than the broker. There's going to typically be a distributor that pays a cheaper wholesale price than the wholesale guy does. You're usually going to have then like a refinery or an assay that pays a cheaper price than the distributor. And then finally, you've got the mint and you've got the miners, and they pay the cheapest price, right? Because they're the closest to the production. So the further you get out, the price goes up, and you get to that retail end, and that price is always going to overlap value on something when I'm chasing it based on price, right? So I'm looking at investing. I want potentially profitable returns, interest, income, or appreciation in value. Now, what does speculate mean? This is like in modern day finance, almost looked at as a dirty word, right? Speculating, here's the definition of it: to engage in a transaction involving considerable risk or the chance of large gains. So we have two different things here: very large risk, very large potential gains, right? That's what speculating is. I have more than average risk with more than average returns. That's it. Flat out, that's the definition of it. Especially when I'm looking to buy and sell with the expectation for a quick or very large profit. So there's like a baseline of speculation: more than average risk, more than average return. That's layer one. Layer two is I'm looking to buy and sell, which again, I'm trading, I'm flipping it at that point. I'm buying at this price, selling it at that price, right? So I'm buying and selling, looking for either a quick profit and or a very large profit, right? Do you see the difference between this and investing, right? Investing, it uses words like acquire, right? Acquire means I'm going to buy something, I'm going to own it, When I acquire a house, I acquire a car, I acquire a wife. That's a intention of buying and holding on to something for a while, right? When someone acquires something, that's what they're looking at doing. I'm looking at potentially profitable returns. I'm looking for interest, income, or appreciation, sometimes all three, right? Which is different than engaging in a transaction. What would be the difference between acquiring something versus simply engaging in a transaction? Right? Acquiring something would be like long-term. It's like getting married, right? Engaging in a transaction, that's like you're just doing an action. It's like a one-night stand. It's like, I'm not really interested in the long-term benefit of this. It's a transaction. It's a quick thing I'm doing. Okay. So that's a big difference in mindset. Considerable risk, right? Now, there's a lot of different types of risk out there. There's a lot of different measurements of risk. What I see happening, especially with, I'm going to isolate the crypto crowd here, is the negation that risk even exists, right? There's nothing more dangerous than that, because even in an investment, risk exists. There's nothing that's risk-free. So when somebody gets upset that you point out the risk in what they're doing, it shows that they're uneducated on what the risks are, and possibly even in denial about what those risks are. Okay, which is super dangerous for them as a speculator or an investor, right? So that's the considerable risk or the chance of large gains. Okay, and I want to highlight larger than average, right? Like average gains. If you talk about average returns, the average person would say, a 6 or an 8 or a 10 or a 12% return is okay. A savvy investor might say a 12 or a 15 or a 20% return is good. I've got investments where they pay me 40 and 50%. I think that's good. But when we start looking at, okay, well, what is considered average? And we start trying to push past that limit, and the average is subjective. It's, for me, I just said I can make 40 and 50%. That might be my average. So if I start trying to push past that, I'm now in the realm of looking for larger than average gains, right? And then again, speculation is based on buy and sell. So anytime you've got an asset where if it goes up in price, it's because more people bought, or it goes down in price because more people sold, that would meet the definition of speculation. Its market is based on the buying and selling of that asset class, right? Not true with investing. The market would be based on the supply and demand of the interest, the income, or the appreciation that it provides, right? Or the intrinsic value that it provides. Okay. And then the expectation, this is the big one, expectation of a quick return or very large profit. Okay. So when I look at, okay, what am I really expecting out of this? I don't think a lot of people understand this when they get into their very first investment of what should I expect? What should I expect from an investment? And if I'm speculating, what should I expect from a speculation? What are my odds? What are my probabilities? What are my track records? These are all questions that I have to not only be able to ask, but I have to be able to substantiate with data, regardless of which one I'm doing. And this is going to be a similarity between the two. Both of these are based on data. Okay. They're not based on, social veneer and fitting in with what's cool. They're not based on clout and hype and all this other stuff. It's based on data. And if I'm looking at anything other than data, then whether I'm investing or speculating, it's going to turn out very bad for me, because in these markets, guys, there are A players, there are A-list investors, there are A-list speculators. Both of them are very good at what they do as a group. They both have a very workable technology and system behind how they do what they do, why they do it, the methods that they use. And those are available to be learned by anybody. So if I'm in one of these categories and I'm not using the methodology, the successful people in that category, I'm putting myself at risk, right? It's like driving without knowing how to drive and not having a license. It's like, okay, cool. Maybe I can start a car, maybe I can get around, but I better hope I don't get in an accident. I better hope I don't have to do any serious maneuvers. I better hope I don't get pulled over. Anything could happen, versus someone that's trained, not only licensed, but they're a freaking race car driver. Probably whatever happens on the road, they're going to be fine with, because they have a methodology behind how they handle a vehicle, right? Do you have that with your assets? So I wanted to point this out. And again, my screen is not looking great tonight, but I think we can see some of this. So the first one here is a scale of risk. So over here on the far side, we've got greater amounts of risk. Okay. So when we have greater amounts of risk, that's pushing us more towards speculation. Right now, realize with anything, there's no absolute. So I can't look at this and say, this is absolutely risky. It's no, this has greater risk than maybe other alternatives do. Okay. On this side, we have less risk. So when I start reducing the risk, I'm stepping closer to the investing side of the scale and further away from the speculating side of the scale. right? Now, I want you to realize there are actual statistical measurements of risk. Okay, so risk is not this thing where we're subjective and we're like, oh, well, it's only risk if this. No, no, no. There are actual risks that are objective and you can put a number on them. Okay, one of those statistics is called a standard deviation. It means what is the rate of return. Lexi, maybe you can help. Daniel wants to know if we can lower the monitor's brightness on the TV. I don't know if that's something you can mess with. I have a course to teach though, so I'm going to keep teaching. So we have the risk, right? So we have this thing called a standard deviation, meaning if we have an average return, okay, that return might be the average, but of course it's not going to be the same thing every year. It might be up, we get a higher return than usual, and within that height, we still get the average, or down, right? We get losses, and if we average the peaks and the valleys, that's where we get our mean. Okay, so the standard deviation would be, okay, well, what is that swing? Okay, how far up can it go? How far down can it go? And that's a measurement of risk. That actually helped already. Lexi's fixing the picture for us. So that would be a measurement of risk. So when I look at something, one of the questions I ask as an investor is, okay, what is the standard deviation? Does it have one? Right? Gold, for example, has a standard deviation of about 15%. Its average return, since we were legally allowed to own it again since the 1970s, it's about 8 to 10% on average. But the deviation is 15, which means it might make 10 on average, but it could go as high as 25, okay, 15 points above, or it could dip below that, right? So 10% is the average, 15 below would be, okay, now we're going basically -5. And that's what I could expect on a normal, if we look at it like a pendulum, right, an up and down sequence. So this is something that I would look at with risk. Now, correlating with that, we have greater profit. Okay, not saying that good profit and large amounts of profit equals speculation, but the definition here says when I'm pushing for very large profits, larger than average chances of gains. So if we push on this gradient scale of more profit, the further over we get to this side, okay, the more we're getting close to that speculation side of things. Think about this. So if I start pushing, and that's the point, is I'm just trying to get profit for the sake of profit. I'm just trying to push that stat, right? That's pushing me more into speculation. Now, if I get less profit on the other spectrum of this, right, I'm starting to get, probably in the midway mark, I would say here and here. This is kind of like the investing sweet spot, right? We want to have good profit, but we don't want to be on the high risk side. So the ideal scene for an investment would be maximum profit, minimal risk. And every time we increase that unit of risk, we're increasing the amount of speculation that we're doing, right? So if we're able to push the profit as high as we possibly can and not increase the risk, that's a very profitable investment. Now, on the very backside, less and less profit. So we get to a point where it's less and less profitable. It's still technically investing, but it might not be investing that you and I would do. Right? So that's something to consider. Another spectrum on this is time. Okay. How quickly does the profit happen? The less time it takes on this end of the scale, right? We're going from more time over here to less time over here. The less time it takes for me to make profit, the more it is a speculation. When I'm getting rapid, quick returns, it's speculation more and more and more as I'm meeting that definition of quick profit. The longer the profits take to happen, I'm falling more into that investing. Okay. And again, like, there would be a point of no return on more time. Like if it's like, hey, you're not going to get paid for 20 years, like a retirement account, sure, that might be investing, but it's not investing I would personally want to do. So this is definitely not saying the more time involved, the better. There would be a sweet spot, right? Somewhere in the middle here, we'd say, okay, this is optimal for investing, right? So there's going to be a vortex of, we've got an acceptable amount of risk. It's lessened as much as we possibly can make it. We've got a great amount of profit. It's not overkill. We're not putting too much risk to get the profit. We have an acceptable amount of time that we're getting paid, whether that would be, and not only there's different ways of getting paid. There's the mode, right? Like I'm going to get paid monthly or quarterly or annually, whether that's my yield or my appreciation or whatever it might be. Then there's also, how long does it take for me to get my principal back? That's another time factor, right? So I'm looking at, okay, well, for me right now, when I'm investing, I'm looking for a monthly passive income. So the time would be a mode of monthly. Okay. But then the other aspect of it would be, okay, well, if I put in 50 grand, let's say I'm making 12% and that's paying me $500 a month. Well, how long does that take me to get my $50,000 back? Right. And the less time that it takes for me to get my principal back, that's where we start getting closer to speculation. Okay. And then the other part is calculated risk versus uncalculated risk. So we have risk no matter what. right? When we get into the realm over here of uncalculated, meaning we're not calculating it. It's not something we're doing a math equation for and working out where the risk is and statusizing it. That is uncalculated risk, and that is speculation. Now, risk is uncalculated for a couple of reasons. Number one is the person doing the speculating doesn't know how to calculate risk. Now, I want you to realize there are risks with investments. So if I buy something that objectively speaking is an investment, but I don't know how to calculate the risk, I'm speculating even though it's an investment. Do you see that? Because it's uncalculated. Whether there's a way to calculate it or not, I didn't do it. So even though it might meet all the definitions of being an asset that I should invest in, and it's a real investment and it's not a speculation, I can use speculation as a verb and speculate with something that was intended to be an investment simply by not knowing and statusizing the risks involved. Crazy, right? Like, this is stuff no one ever taught me. Guys, I had freaking financial advisory licenses. This is not stuff I ever learned. Calculated risk is the other one. So on the far end of the spectrum, on this end, calculated risk. Okay, again, that is risk that I've calculated. I put a number to it. I put a stat behind it so I can actually see, okay, this is risk. I've done the math. I understand the probabilities. I understand the number. I know how to track when that risk is present, when it's increasing, when it's decreasing. Okay, that's calculated. So when I calculate the risk, it makes it less of a speculation, more of an investment. Okay, now this part is based on my literacy level, right? Being able to calculate risk only comes from studying numbers, studying investments, experience, being involved. All of these things equate to me being able to calculate a risk, right? So these are all factors. Now, the other thing is, what is the action focus on? Right. So when I'm investing focuses on, number one, financial indicators. Okay. Financial indicators. What are the financial stats that I'm looking at? Okay. The stats that I'm looking at with an investment, there's going to be things like rates of return. And there's going to be things, like I said, like calculations of risk. And there's going to be, even beyond the rates of return, what are the things that make the rate of return? Is it income? Is it appreciation? Is it an underlying asset? Is it a multiple on the earnings of the endeavor that I'm getting involved in? There's actually reasons why there are rates of return. Okay, now this is the thing I think is a shame. There's a lot of technology, there's a lot of innovation. I think, the Coinbase and the Robinhoods of the world, these are things that make us hyper focused on returns. Okay, what is the rate of return? What's the price? And that's great, because I don't think people focused on that really before. I think there was a lot of illiteracy and inability to access investments. But the unsavvy investor doesn't know that that number that they're paying attention to represents underlying factors. And so when we look at the number, we don't just look at the number and stop. We look at the number and say, okay, great. Why is that number happening? And then we look at the underlying factors and we make sense of the number. Right? It's like, when somebody says your pulse is, way too high. Okay, great. Well, you don't know why. I could have been doing cardio. I could have had way too much espresso. I could have, just had a scare and my adrenaline is up, or I could have heart disease. But you don't treat based on the fact that the heart rate is high. That's an indicator. And then you look at the underlying factors as to why that's the case. No different with investing. Great question from Dan. He says, what's the difference between appreciation and yield? So appreciation means that the value of something has gone up, right? So if I'm looking at the total worth of, like, let's say a real estate building, the value of that building is increased, right? And so that's going to be the appreciation, the difference between what I bought it at and what it's worth now. The yield would be, what is it paying me as a percentage of income? So let's say it's generating, $10,000 per year in rent, and it's worth, let's say, $100,000, right? So my yield there would be 10%. My income is 10% of the price or the value of that building. So that's the difference between the appreciation and the yield. So you're investing for either of those things, right? So mathematical formulas on investing, those are one of the primary factors we look at. And then also the underlying things that create that mathematical indicator. Historical performance is another one. Okay, historical performance. Now, in the speculating world, this one has been, unfortunately, again, kind of tainted. People look at historical performance and they then come up with, oh, that's antiquated. The 50 years, that means it's old and it's outdated. No, sometimes 50 years or 100 years or 6,000 years or whatever the years are means strength. It's been around long. It's stood the test of time. Okay, new is not always better. In fact, with investing, new is usually not better for most people. Established is. Track record is better. Things that consistently pay out are better, right? So that's what we're looking for, is we're looking at historical performance. Why would that be? And it's not just to show, here's a tip. It's not just to show, oh, the rate of return did this over so many years. It's to show during different periods, how did this investment behave? How did it perform? During, the tech bubble, how did this asset perform? Regardless of the return, I want to know during that condition of economics, what happened? Okay, how did it react? Was it negatively impacted? Was it positively impacted? Right? During the Great Depression, how did it perform? During the Civil War, how did it perform? When we were getting taken over by Great Britain, how did it perform? See, that's why we look at track record. It's not just to say, oh, it's 12% for the last 50 years. Like, that's bullshit. And it doesn't mean it's going to happen again. We want to know if the same kind of conditions happen: wars, depressions, recessions, innovations, revolutions, right? How does the asset perform, and what could we expect if it were to happen again? That's the reason we look at track record. So for those of us that say track record doesn't matter, it means things are antiquated, you're shooting yourself in the foot. Like, you're putting yourself in the position of having to speculate because you have nothing to look back on, right? I don't like when I don't have things to look back on. I want to know what happens. I can try and figure out what is going to happen, right? So historical performance, mathematical calculations of value. Any good investment is going to have this, a mathematical calculation that tells you the intrinsic value of that asset. Okay, if it does not have that as a formula, it's not an investment. If you can't calculate what is it worth, regardless of price, what is it worth, right? Based on earnings or book value or, rent roll or cap rate or whatever it might be, all these different indicators in the investing world, I can use those and I can come up with a value. Okay, because here's the deal as an investor. And again, this is the difference between retail consumerism and investing. Retail consumerism, I go on an app or a website, I see something that looks exciting, it's listed at XYZ price, and I'm like, oh, I'm going to buy that because of whatever reason. That's consumerism. That's like going through the McDonald's drive-through and saying, hey, I want the number 4, and I'm going to pay $7 and I want to buy that. Okay. Real investing, I look at the price and I say, bullshit. Okay, bullshit. I don't believe that that's the price. Okay, and I'm going to look at, okay, well, what's the value? Price is what I pay, value is what I get. So I'm looking at the price, and I'm basically trying to disprove the price through the mathematical calculation of value. And if I can disprove the price showing one or two scenarios, the value exceeds the price, more value than it costs, then I buy it. Okay, if I can prove the price wrong by saying the price exceeds the value, then I don't buy it. I can't do that if there's no mathematical calculation of value, and I can't do that if there's no such thing as intrinsic value. Right. So these are like things that have stood the test of time, guys. This is not new stuff. That's like theory. It's practical application. Every successful investor ever has used that basis. Couple questions here. We have what's book value and cap. So book value is basically looking at what's the net worth of a business, the assets minus the liabilities of a company. And then that would tell you, okay, well, that's a calculation of what it might be worth, right? If it didn't have earnings and other things. Cap rate means capitalization rate, and it's actually the same as the yield. We take the net income and we divide it by the price of the asset, and that gives us a percentage, and that's the capitalization rate. Sean asks, can you please explain intrinsic value? So intrinsic value this is a great question. Intrinsic value would be the actual worth of something in and of itself. Again, I like to use real estate as an example of this. If I buy real estate, there's going to be a intrinsic value, a worth that the real estate has in and of itself, because A, it's land, right? Land is valuable, land is scarce. B, it has septic, it has a well. Those two things are valuable. C, it provides shelter, it's got utility, right? And then D, it's also got, generally speaking, rent coming in or some sort of obligation that someone else owes me to use that property or to live in it. So those would all be things that are basically creating that intrinsic value. Okay, another good example would be if you were to take, gold as another example. 6,000 years it's had intrinsic value. You take that, you go to an Amazon rainforest jungle tribe, and you give them that gold. They know it's worth something. Even though you didn't say the price, they know it's worth something. So usually it's going to be what's the use, the utility, the actual value that it brings, that it delivers to its end users, regardless of what the price would be. Very good question. Mark asks, how do we know we're paying a good price when buying gold and silver? So Mark, that's a great question. So that's kind of subjective, because dollars used to be priced in gold. And prior to that, they're priced in gold and silver. So in 1971, they flipped it and they made it to where everything is priced in dollars instead of the dollar being priced in gold, and everything really was based on gold back then. So when you're looking at buying gold and silver, it's a long-term hold and it's a store of value. It's not an investment, meaning it's not going to pay a yield. We're not buying it to sell it later at a profit. We're buying it to store value instead of storing value in dollars or in ETFs or whatever else we might store those dollars in. So I buy gold regardless of price. The prime example that I like to use is the Federal Reserve Bank. They own almost $500 billion worth of gold. Okay. It's priced in statutory pricing from 1971 or 74, I think, at $44 an ounce. Okay. I think it's over 8,000 tons, TONNES, like, so not metric tons. It's the other kind of tons, which is actually higher. So it equates to, in today's dollars, almost $500 billion, and they misprice it at $44 an ounce because they don't give a damn how much the price is. They're owning it by ounce. So again, it goes back to the numerator and the denominator. Gold is the actual numerator. It's denominated in dollars, but dollars don't mean anything. Okay, so when I'm storing value, the dollar is the actual thing I'm defending against. And so I'm actually buying real tangible things that I know will be around, and then they keep that value and retain it for me. So that's my definition there. So back to the investing. So we're looking at, again, financial indicators, historical performance, mathematical calculations of value, some future forecasting. Like, we're going to look at what's the vitality of the investment in the future. If it's like, hey, Kodak, and we know that pictures are going away, or Blockbuster, and we know that retail storefronts are going away. Okay, we want to do some forecasting and see that. Now, this is probably the least important, okay, because this is not something that we can actually prove, right? So we look at the future forecasting, and then we also look at profitability over time. Okay, this is the main thing. When I'm investing, my goal, my focus is profitability over time. As I hold it, how much do I make in profit? That's the reason I'm getting it. Okay, so again, I want income, I want interest, I want appreciation over time. And the longer I keep that thing, the more profitable it becomes for me. That's why it's a long-term game, right? So that's investing. A couple other questions I'm going to answer really quick. We have, we covered the gold and silver one. I think we have one on track record. So historical value and track record. So Daniel asks, is historical value the same as track record? So it would be a semblance of that. So track record could be, it could include what's its historical value been. It could also be historically, what has it been priced at? It could be, supply and demand factors and other things that are looked at within the track record, but it would be an element of track record for sure. All right, now speculation. Let's go back to speculation. Speculation focuses on both financial and non-financial indicators, right? Now, I want to get this across, guys. There are professional speculators. I know them. One of them is my best friend. He runs a foreign currency trading hedge fund. I invest in his hedge fund as an investment because it pays income and it's got a track record and it's got profitability. Within that hedge fund, he speculates. He buys and sells currencies and trades them against each other. He's a freaking pro at what he does. So he looks at some financial indicators. There are certain things he's going to look at on, okay, what is this currency at? What is that currency at? What's going on financially? Then there are also non-financial indicators. He looks at what's the greed and the fear levels in the economies right now. Okay. What's trending on social media, right? Like, these are all elements of actual speculation. So again, saying someone's speculating is not a dirty phrase. There are very good speculators out there. I invest with some of them, and then a lot of them are terrible because they don't want to admit they're speculating. Okay. If you admit you're speculating, you can at least go full bore and be world-class at it. But if you're speculating and trying to say, no, I'm investing because I don't want to admit that I speculate because I think that's where that word's bad because I don't actually know what it means, that's where you're going to have a tough time speculating because you won't even admit that that's the thing you're doing. I've got to say, okay, I'm investing, fully embrace that, and then go in on it. Or I've got to say, I am speculating, fully embrace that, and then go in on it. And I can be world-class at either of those things, right? Now, I think there's timing for each of them, and I'll talk about the timing in a second, but there are distinctions. There is one, there is the other. There are professionals in both industry, and there's amateurs in both of those groups as well. Okay, so we're looking at financial indicators and non-financial indicators. Now, here's the one that I see happening, unfortunately, with a lot of today's amateur speculators on the retail end of things. They're looking at the non-financial indicators they are not looking at the financial indicators. Okay. They're looking at like, what's the market appeal? What's the innovation? What's the clout of this thing? And all these different things that are great for measuring like social perception of this thing, but they're not looking at the numbers. They're not coming up with calculations. They're not looking at anything other than it's trading at this. And I think it's going to go up to that. All these people like it, so I'm going to buy. Or it's the way of the future. That's the dumbest one. That doesn't mean anything. Like, why would that be a reason for investing in something? It's the way of the future. How? Why? Prove it to me. Show me some numbers. Show me some math. If you can't, like, I don't know how you can say it's the way of the future, right? Not saying that something is or isn't, but I'm saying there should be a thing you can show and prove and say, this is why I think what I think. Okay. So, sometimes historical performance does get looked into with speculating, not as often. And then there is lots of future forecasting. Speculating depends on attempting to know the market better than the market knows itself. Trying to say, okay, I think that this is going to happen, pinpointing the financial and the non-financial aspects of why the price moves on a certain asset or thing, and then using that to my advantage to be able to buy it low and sell it high. Okay. Now, a good speculator, guys, is able to do that over and over and over and over and over. They have it down like clockwork. Like I said, my Forex guy, he produces about 40 to 50% returns. He pays me half, which means he's actually making 90 to 100% returns annually, which means he's doing month after month of, sixes and eights and 10% over and over and over. He doesn't lose. And I'm not saying it's guaranteed, and I'm also not offering for you to invest, but I'm saying that is a indicator of a really good speculator. He just freaking like clockwork, boom, 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 because he's able to buy and sell because he has all of these factors down so well, and he knows he's speculating. If you ask him, he will say, I'm a trader. I trade, I speculate, and I'm really good at it. Okay, that's fine. Okay, and then the biggest thing with speculating is a profitable exit, regardless of profit over time. It's okay, what's my strike price and what's my sell price? Where did I buy? Where did I sell? What was my margin when I sold? That's the only thing that matters. Okay. Track record, time horizon, all of that is secondary to what is the profitable exit. And if there isn't one, I failed in both arenas. I wasn't investing or speculating. Okay. At that point, like, I was basically just, going in and having fun. Maybe I wasn't even having fun, because when I'm losing money, I'm not having fun. So what was I really doing? Okay. Dan asked, what's the strike price? That's the price you're going to strike at. Usually that's your buy or your sell. At this price, I'm going to make a move. I'm going to get in or I'm going to get out. And then the time horizon would be, how long does the trade last? Sometimes they're, literally hours. Like, I'm going to get in here, get out there at noon. I'm in at 2 p.m. I'm out. Sometimes they're days. And then sometimes they can be weeks or even months for the trade to play out over time. So that's kind of the time horizon of the trade. These are Jerry-isms, my terms. I'm not a trader or a speculator. So there might be traders that are like, that's not technically what we call it. That's the concept, though. You're getting it at a certain price. You're getting out at a certain price. You've got a length of time that's passing before that trade gets done and you get out. Okay, now here's the kicker. This is one that I wanted to point out. So an object can be can be an investment, right? So I can say, okay, this piece of real estate is an investment. Why? Because it possesses the qualities of an investment. Okay, it has income, it has, maybe interest, it has appreciation, it has intrinsic value, it's got track record. These are all things that would make it, ripe for the picking of being an investment. Okay, now an action can also be an investment, meaning I'm going to invest in a certain thing, meaning I then demonstrate the characteristics of investing, right? Doing the research. We're going to talk about what all those steps would be: doing the research, underwriting it, doing due diligence. All of these things would be actions that would characterize an investment as happening. So there's going to be the noun, the object or the thing that is an investment. Then there's the verb of actually investing, right? With speculating, an object can be a speculation, right? So I can take any object and I can speculate on it. I think this is going to happen. Here's my data. Here's my social data. Here's my financial data. Here's why I think it's going to happen. Here's my entry price. Here's my strike price. I could literally do that with this hat. Okay. A little bit of a trippy one. Amazon is that. Okay. Speculating on what people are willing to pay for books and cups and household goods. Okay. Most people don't know Jeff Bezos was actually on Wall Street. I think he was a foreign currency trader. Double check on exactly what he did. He was a Wall Street tycoon before he started Amazon. Okay. So if you look at that, it's the same thing. He's buying and selling tangible goods. He's buying at one price, selling at another. He's speculating on what are people going to want and need. That's a professional. He's very good at it. Okay. Now, granted, Amazon didn't have earnings for the longest time. So his shareholders felt that it was a speculation through the fact that they didn't get dividends. The stock didn't perform well for a while. Now he's hit his stride, right? There's earnings. Everything is great. Okay. So an object can be a speculation. An action can be a speculation, meaning I can act like a speculator with something that might not be a speculation in and of itself, right? So I can demonstrate the characteristics of speculating, even though the thing that I'm demonstrating them on might not be a speculation in and of itself. It might be something that's an investment, but I'm treating it like a speculation. Okay. Daniel asks, what is underwriting? Underwriting means that I'm performing a systematic researching and fact finding to discover risk, right? So underwriting happens with investing, where I look at the deal, look at the numbers, and I try and discover the risk so that I can defend myself against it or just stay out of it entirely. That is also an insurance term. So when you go through underwriting for insurance, the insurance company is literally looking at you and trying to find where do the risks exist with this person. And then they're either going to say, okay, that's an acceptable risk, or it's not. We're going to exclude the risk, but insure the person, or we're not going to insure the person at all because of that risk. Okay, so we should all be doing that with our investing. Now, here's the kicker. An investment can be treated as a speculation. Okay, I could buy a piece of income producing real estate and treat it as a speculation, even though it's meant to be an investment. I could buy a business that produces profit and cash flow and treat it as a speculation, even though it's intended to be an investment. Do you see that? But a speculation, a speculative object, cannot be treated as an investment. This is where they're different. This cup does not produce income. Okay, this cup is not going to appreciate in value and it doesn't pay me interest. Therefore, I could take this cup and I could try and say it's an investment, but it's not. No matter how hard I try, no matter what words I use, no matter how I try and justify that it's an investment, this cup will never be an investment. Because by definition, it's either going to be just a consumer good, something I use and drink out of, right? Or it's going to be a speculation. I try and sell it to you for more than I made on it. Sorry, more than I paid for it. Okay, so it doesn't go both ways on that. You can speculate with an investment, but you can't invest with a speculation. Okay, and if you look at this and you demo it out and you sketch it out and you look at it, you're going to see that that's the case. And this is where people are going wrong today. They're taking speculations and trying to say they're investments. Okay, that's not the case. It never will be. It's not workable. Okay, if it was, I would be doing it right now. The 1% would be doing it right now. Okay, but they don't. Okay, so speculation is ultimately based on possibility. Speculation means what could happen, what's possible, right? And then I'm then taking a position and saying, okay, well, out of all the possible outcomes, I think it's going to be this one. And I'm going to stick with that outcome. And I think I'm right because of whatever factors and reasons. And maybe I am, maybe I'm not. Okay. Investing is based on probability. We look at statistical data, evidence, track record, calculations, and say, okay, based on the numbers, this is the most mathematically likely thing to happen. There's a giant difference there. Okay. Speculation, I'm going with my gut. I'm going with reading the pulse of the market. I'm going with, social behavior and social media and all this other stuff. Investing, I'm going off numbers only. Okay. Those are the two main differences. So if I was investing, let's go through the steps. How would I go about investing? If I was investing, what would the steps look like? Number one is I would need to determine my needs. Okay. I would need to be asking, what am I trying to get out of the investment? What do I need? Do I need income? Okay, am I looking to replace my income? In my case, that's what it is. I'm looking for passive income that exceeds my savings, expenses, and taxes. So am I looking for that? Am I looking for appreciation where, I'm not looking to be financially free. I'm looking to retire when I'm 65. And so I'm just looking to grow my nest egg up really, really high over the next 40 years. If that's my goal, then that's my goal. I need to determine my needs. And then once I've determined my needs, I need to staticize them so that I can measure them out. And I can say, okay, these are my needs. This is how I'm going to measure whether or not those needs are being met by an investment, right? So if it's income, how much? What's my yield? What's my rate of return look like? If it's appreciation, it's more like, okay, what's my total starting amount and my total ending amount? And what's the annual growth rate that I need to go for, right? But I would need to find a stat. Then I would need to find an investment that meets those needs. So if it's income, probably not going to buy raw land, probably not going to buy gold, right? And again, those wouldn't be investments. I would say those are stores of value. I'm probably not going to buy a tech stock that has no earnings. I'm probably not going to buy Tesla. Probably not going to put everything in a retirement account because those things don't produce income. Okay. Once I figured out the investment that meets my needs, I'm going to educate myself on that investment. With investing, Dan asked, what's raw land? Raw land is undeveloped land. So it's just literally just, a lot or a park or whatever. It doesn't have a building on it. Oftentimes it doesn't have septic or a well either. Literally just is raw land. So once I've got the investment, I'm going to educate on it. I'm going to learn about it. And again, when I'm investing and also when I'm speculating, until I reach a certain level of education, I contain the most amount of risk of all parties. Meaning my lack of knowledge is the biggest risk in the investment until I get the education. Okay. My lack of knowledge is the greatest risk in speculating until I get the education. Right. So I'm educating and then investing. Once I'm done educating, I'm then underwriting. Meaning I'm searching for risk. I'm searching out the risk. I'm looking through, historical records, financial statements, anything I can get my hands on so that I can research and find out where's the risk. Okay. Where's the risk? And I need to determine what my acceptable level of risk is and determine, do I invest? Do I get out? Or do I find a way to mitigate and exclude the risk or insure against the risk? Right. Once I've figured that, if I decide this is the right thing, then I look at, okay, what is the value and what's the price? I attempt to find the difference. Okay. If the value exceeds the price, no brainer. If the price exceeds the value, that's a lot harder to convince me to do. Why would I buy something that's not worth as much as what they're charging? Okay. That's called getting ripped off. If I sell you a good as a consumer, say I own a restaurant, I sell you food, I mark it up like it's a 5-star menu, and then it turns out it's only 2 stars, you're not going to feel good about that. Okay. Same thing with investing. Okay. So value and price. And then finally, I do due diligence. Okay. Due diligence means after I've figured out what's the price, what's the value, everything before, then I look for, okay, are there any reasons why I shouldn't do the deal? Okay. I'm literally trying to find reasons not to. I call this shooting holes in it. Okay. I'm looking for, and I had this conversation with someone. With investing, to be profitable and great at investing, it actually helps to be a pessimist. And I'm not saying that as a permanent attitude or beingness. I'm saying, no, think about worst case scenarios. That's what your due diligence is about. What's the worst thing that could happen? And I want to think through those scenarios and ask, if this occurs, do I still want to invest? What's the worst thing that has happened? When that happens, would I still have wanted to own this thing? And if the answer is not yes, then I don't get involved, right? Finally, I invest. Okay. And this is just on a freaking iPad screen, guys. Like the actual mass of this, like if you talk to a good real estate investor, they're going to tell you for every 100 deals they look at, they might find 2 that they like. Okay. That's a lot of work. That's a lot of data. That's a lot of looking and searching and being able to analyze. And most people don't do this with their investing. Okay. When you don't do this, you're not calculating the risk, which means you have uncalculated risk and you're actually speculating when you should be investing because you're not taking these steps. Okay. Now, what does speculating look like? It's totally different. With speculating, the first thing I would do is I would find a trend. Okay. What's a trend? What's something that's popular right now or that I think is going to be popular right now? Because I'm projecting into the future. Okay. So what's a trend? I'm going to research the trend. I'm going to try and learn as much about it, the trend as I can. Then I'm going to validate the trend. Okay. I'm either correct that this is a trend and that it's going to continue onward, or I'm not. And I'm incorrect and it's not going to continue. And if it's not going to continue, then I go find a new trend. If it's going to continue, I stick with that trend. Okay. So validate the trend. Then I find or make a market. For speculating to happen, there has to be a market. It's different than investing. I don't need a market to invest. I just need an investment. I need an asset that meets my criteria, regardless of if there's a market of buyers and sellers for that thing, because I plan on keeping it forever, right? With speculating, I have to be able to buy at one price, then find another party that I can sell it to at a higher price, which means there has to be a market. So I have to find a market that either already exists or I have to go create one myself, meaning I have to go get people interested in buying it and selling it between themselves so that that becomes a social behavior and the masses are doing it. And then I have a better chance of riding those waves, so to speak, right? So I have to find one or make one. Now, this is the point that I want to make sure everyone's aware of as a speculator. There are groups that make markets. as a profession, and they're the best in the world at it. And they used outlets like the news and CNBC and your ads on social media and influencers. When you see freaking Kim Kardashian come out and saying she's investing in cryptocurrency, do you really think she researched the crypto, or do you think a market maker paid her to say that? A market maker paid her to say that, right? When you see professional athletes coming out saying, I want to get paid in Bitcoin, do you really think they really want to get paid in Bitcoin, or do you think someone's paying them to say that? Someone is paying them to say that. No different than the reason LeBron James says he eats McDonald's and drinks Sprite. We all know that's bullshit. The guy eats chicken breast and fish and vegetables, and that's it, right? It's endorsements. They're paid endorsements so that a market can be made. Okay. So there are market makers. You are not, you're not one of them. I hate to say it this bluntly. You're not one of them. Okay. If you're not a billionaire, you're not one of them. George Carlin says it's a big club and you ain't invited. That's where the market makers hang out. You and I are not invited into that club. Okay. We're the pawns. We're the people that are supposed to be in the market being taken advantage of, not the ones making the market. So I either have to be very vigilant when I find one to make sure I'm going to find a market. I know I'm not the market maker, but I also know I'm not a pawn. Okay. Warren Buffett has a quote saying, if you're at the table and you can't find who the idiot is, it's you. Okay. So I have to make sure I'm not the idiot. Okay. And then otherwise, I'm going to stay out because there's market makers that can stomp me. They can crush me. And so I have to be aware of that. Okay. When I get in, before I get in, I set my exit price. This is important. Speculating is something that I have to be unemotional about. I set my exit price. This is the price where I leave the trade no matter what. Okay. If it's a loss, I cut my loss. I take it. Okay. If it's a gain, boom, I get out. Okay. So set the exit price. Then I deploy the capital. Then I create market displacement. Guys, this is an indicator. When you see people going out there and pumping up, this tech company or this cryptocurrency or this NFT, they're creating market displacement. They need enough people in the pool to get the water to rise so that they can pull out their profits. Okay. Example, Gary Vaynerchuk with NFTs. Everyone loves Gary Vaynerchuk, right? Awesome. Maybe you do, maybe you don't. He's creating market displacement by telling everyone on TikTok and LinkedIn and whatever other feeds he uses, get an NFT, buy this NFT, buy that NFT. Meanwhile, you don't know he's having conference calls with Logan Paul and all these other, millionaire, billionaire influencers saying, hey, we're going to sell these guys all the NFTs and then we're going to pull out at a profit and they're going to be holding the bag. Those are real conversations that happen. That's called creating market displacement. Elon Musk did that in 2020 with his Bitcoin. He bought a bunch of it, said Tesla was going to accept it. And then he made $150 million on it, said Tesla wasn't going to accept it anymore. And then talked trash about it on Saturday Night Live and crashed it, right? That's called creating market displacement, getting enough people in the pool to where the water rises. And then you make the exit. Okay. If you're good, you can do this over and over and over with the same trend. Because again, the idiots don't know that that's happening. And so you can keep doing it over and over and over until they catch on and say, hey, we keep losing money and Elon keeps getting rich. We shouldn't buy the same stuff he buys anymore. Until they catch on, a good market maker, a good speculator is going to be able to continue that trend over and over and over with the same object. Right? So that's the game, guys. A couple questions I'm going to answer. We'll jump into the final part of this. Vanessa says exactly use media to manipulate people. That's the reason media exists. Sean says, I love and admire your candidness. Thank you, Sean. Daniel asks, what does it mean to deploy capital? It just means putting your money to work, right? So if I'm deploying capital, I'm taking the money, I'm putting it into the deal. I'm putting it into the investment or into the speculation. Nano says, and Elon gained followers. It's one thing he definitely did do. Okay. So here's the questions that I want to wrap up on for tonight. When do we invest? Okay. When would this happen? We would invest when we're financially literate and we're solvent. Okay. If I'm not financially literate and I'm not solvent, I have no business investing. Okay. That's when I would invest. I would invest until I achieve financial independence. Anyone that's watching that's been a client of mine or a follower of mine knows financial independence is defined as passive income greater than savings, expenses, and taxes. Until I've achieved that, I keep investing. Okay. I don't speculate to get there. And guys, like there's not there's a time where you would speculate. And that's the next question I'm gonna answer. When would you speculate? It's not when you have $3,000 to your name. Okay. It's not when you halfway tried investing and you couldn't figure it out because you were financially illiterate and it didn't work. Okay. It's not when you can't figure out how to earn more income because, you're lazy or you're introvert or you're whatever. And so you don't exchange with other people. That's not the reason why you would speculate. I had a guy email me this week, vicious to me in the Facebook comments when I was talking about Bitcoin this week. And then he emails me. He's like, Jerry, you know what? You're right. The reason why I'm speculating is because I can't for the life of me figure out how to increase my income. And so this seems easier than making cold calls and selling. Okay. I hate to stereotype because it's not politically correct to, but I'm damn good at it. And I already knew that. Most people that are not financially independent that are speculating, think of it like a prison break. They're trying to climb the fence while the guards are still looking. There's a chance they're going to get shot. There's a chance that they're going to get out. They're going to do it anyways because they're saying, well, life in prison sucks anyways. I'd rather die and at least I can get free. Okay, that's called apathy. Okay, it means I've quit on the thing that's going to get me free versus I'm really trying to break out of prison. I use this analogy all the time. It's going to be a prolonged plan. I'm going to have everything planned out. I'm going to have bought out the inmates and the guards. I'm going to dig the tunnel. I'm going to do all the work so that when I get out, I'm undetected and I never go back. Okay, and I can help other people get out. I can't duplicate, run over the fence and hopefully you don't get shot. Right? Like that's not a solid, sound plan. So when do we speculate? When we're already financially independent. When we are already financially independent, that's when we can speculate. Why would that be? Because then I don't have to worry about losing. Okay. My full-time job could be, let me go find interesting trends and I'm going to speculate on them. And that's it. Okay. And I don't have to worry about losing money. My buddy that I just talked about that does the hedge fund. What I didn't tell you is we've been friends since middle school. When he was starting his business and I was starting my business, he went broke. I can't even count how many times, losing all of his money on trades, going back to the construction job that he friggin' hated so that he could get enough money so that next week he could lose it all again. And he did this for years and years and years until he figured out the trading thing and the speculating thing and he got good enough about it. Okay. And he still took one big loss before he really got his act straight. So that's hard. That's harder than just working a job. That's harder than just investing. That's harder than building a business, in my opinion. Right? The duplication level on being able to repeat that and him being able to teach someone else how to do that is so small. Okay. It's not easy. And so that's what I'm saying is a lot of people speculate because it appears like it's easier because you don't see the effort that goes into it. You just see the social media post. I bought Zonk coin at this and sold it for $10,000 more than I paid. Okay, you don't know, whether that was a fluke, whether they did it again. You don't even know if they're actually telling you the truth. And I can tell you the ones that are doing it over and over and over and over, they're like my friend that runs the hedge fund. They've been doing it for years. And that's the part you don't know. Okay. You don't know where they got their startup capital from. You don't know where they got their education from. You don't know that they have an accounting degree. You don't know that they were the valedictorian in their high school, the smartest kid in the entire school. Like you don't know these things. You just know that they said they bought Zonk coin for $10 and sold it for 10,000. Okay. And we have to look at better data than that. So we speculate after we are financially independent. Okay. After we've already broken out of the prison, because then you're free to do whatever you want to do. And you're not going to have to worry about going back. Right. So guys, I hope that this has helped you. What I want to do is I want to open this up for any live questions that we have. So I know we answered some of them in the middle here. What I would like to do is if you have questions on Zoom, on Facebook, whatever it might be, I want you to drop those in the chat or in the comments and we will talk more about those. So let me jump on Facebook first. Justin, good to see you. Justin says, so no one night stand investments. Got it. So he also adds, after we got to the top of our business, I made my first significant investment in a deal with a well-known social media influencer. I was promised a 15% rate of return. I currently get 4%. Supposedly I'll get the other 11% per year, but time will tell. Either way, I won't invest in this fund again. I was unsophisticated for sure. Thankfully, Wealth Dynamics showed up and has been teaching me about financial literacy. I've learned and invested with Wealth Dynamics and will continue to do so. Thanks, Wealth Dynamics. That's an awesome testimonial. Thank you for sharing that, Justin. Let me see if we have any other questions on Facebook here. Brianna says, you're explaining these things in a way that I'm finally starting to understand. Thank you. That's awesome. That's what it's all about. Guys, I went to friggin' Houston High School, not Houston, Texas, Houston, Alaska. There were 60 kids in my graduating class. I was a C average student. Like I didn't go to college. My parents were divorced. I'm not supposed to know this stuff. So the good news is if I can figure it out, you can. Okay. And I'll share everything that I know with you. I always have, I always will. But that's the reason why I do what I do is we should all be able to invest. We should all be able to know this stuff. And we shouldn't be left to the whims of financial consumerism and speculating because we can't figure it out. Good. I think that's all I see on Facebook. Let's see what else we have on Zoom here. Daniel says this was so helpful. Thank you. You're welcome. Dan or Nano says this is a very in-depth webinar tonight. Lots of foundational concepts with definitions that if someone gets and applies, it will alter how they behave and put them in a better or true financial path or for actual prison break, quote unquote. Okay, cool. I think Daniel has a pretty good question. Let me bring Daniel on really quick. I also just like talking to Daniel. I used to talk to Daniel like every day because we were quarantined in LA together. How are you tonight, Dan?
Jerry, I am so psyched. This is so informative. It's like mind-blowing how far you can travel in so little time.
That's awesome. I'm glad to hear that. Thank you.
Yes, I just wanted to, if you could give a simple example of how you take a look at the math in deciding if an investment is a good one for yourself. If you could just give a very simple illustration, well, how do you do these mathematical calculations? Like how exactly does that work?
Yeah, so all of them are going to be a little bit different. And this is where it depends on what you're investing in, right? So for example, if you're, and I can't give you we'd have a whole freaking, what's that Robin Williams movie, A Beautiful Mind? We'd have a whole Beautiful Mind chalkboard out here. But let's say you were doing real estate, right? So you would look at, for example, what are the gross rents? Okay, what are we collecting gross? What is my vacancy? Okay, what are my operating costs? Management costs, et cetera. What are my taxes, insurances, all of those things. And then you would eventually come to an equation of what's the net income. Okay, and this is something you want to look at. What's the net income? And then you'd also look at, okay, well, what are the assets? Are there other structures, other fixtures? If it's a company, what else is on the balance sheet? Is there cash? Is there other assets? You have net income, you'd have other assets. And most of these are going to be what's called a future value calculation, meaning you're going to do and this is not something I'll very easily be able to describe to you, unfortunately. There's an investing calculator. You would do a future value calculation. You look at what's the present value of the assets and income. And then if I were to push that out and project it into the future at a discounted rate, what is the total of that? Okay. And that total would give you some sort of calculation of the actual value. Okay. So there's a lot of different ways you would go about this. If it's stock, it's completely different. If it's lending, it's also completely different. So that's part of learning. And again, it goes back to this very first point of finding the investment that meets my needs and then educating myself on that thing, right? I like lending. The easy way with lending is I look at what's the loan to value, right? How much am I loaning them? And then how much is the thing worth? What's the underlying income? Like those are all easy things. And that's part of why I love lending is I can run with it and I can calculate those things out pretty quick, right? There's not a lot of research that goes into it in the underwriting stage because I can get all of the documents and financials really easily. So that's the best I can answer it on the webinar tonight. Dan asked, gross rent is total rent the property gets. Yep, exactly. So the total rent the property gets for the year, and you would then subtract all those other numbers and back them out. So very good question from Dan. Let me see if we have any other questions before we tune out here. I want to thank everyone again for tuning in tonight. I think that's it. I don't see anything else so far. Crystal says, thank you. Jen says, off to the second job added, girl. That's what I'm talking about, working that second job. Guys, so we're going to tune out for tonight. What I want to say is thank you for tuning in. If you have not grabbed a copy of my book yet, go to jerryfetta.com, get Blueprints of Financial Freedom. Okay, this is an excellent starting point. This is exactly what I use. This is exactly what my clients use. I got this by researching the top 1% of wealth historically and what do they actually do to build wealth. So again, that's jerryfetta.com/B2F. That's the letter B, the number 2, the letter F. We will be back again next Friday, same time, 10 p.m. Eastern with our next topic. Have a great weekend. I'll talk to y'all next time.